Hi guys. Today we will analyze Micron Technology stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Compared to the overall market, Micron is an average performer. The short term is neutral, but the long-term trend is still positive. Support levels are around $91 and $86. Strong support levels are around $83, $75 and $66. Resistance level is around $97. In the last month the stock has been trading between $80 and $96.50 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 22 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 24% per year, for last 5 years. We see that the average profit margin of the stock has been around 27% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 44% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Micron Company: bad, average, and good. First scenario. Micron will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 8%. Future profit margin would be low, 22%. Future free cash flow to net income rate would be low, 40%. In this case, the fair value of the stock today would be $50. Second scenario. Micron will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 10%. Future profit margin would be average, 24%. Future free cash flow to net income rate would be average, 50%. In this case, the fair value of the stock today would be $72. Third scenario. Micron will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 12%. Future profit margin would be high, 26%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $99. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 6.47. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Micron Technology, analysts forecast growth rate around 12% per year in next 5 years, and future P/E around 13. Again, I will use 3 different scenarios for Micron Company: bad, average, and good. First scenario. Micron will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 8%. Future P/E would be low, 14. In this case, the fair value of the stock today would be $65. Second scenario. Micron will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 10%. Future P/E would be average, 16. In this case, the fair value of the stock today would be $88. Third scenario. Micron will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 12%. Future PE would be high, 18. In this case, the fair value of the stock today would be $116. As you can see, today the stock is fairly valued, $93, if we expect the company's high performance in future. The fundamentals are good. But the stock is currently a little bit overpriced in my opinion. I own the stock and I would be happy to buy more when the stock drops below $70. Company's strengths. Micron is the largest U.S. memory company and a leading global supplier of DRAM, NOR and NAND memory. The company provides memory solutions for computing, communications, consumer, and industrial applications, and serves both wireless and embedded applications. The ongoing secular shift toward cloud data center, along with continued demand for traditional connected devices, PCs, smartphones, should fuel long-term growth in the memory market. Micron has a return on assets of 12%. This is better than the industry average of 7%. Its profit margin of 25% is amongst the best of the industry. Based on estimates for the next 5 years, Micron will show a medium growth in revenue. The revenue will grow by 12% on average per year. The earnings per share is expected to grow by 24% on average over the next 5 years. Risks. In the client space, OEM customers continue to defer memory shipments because they lack other non-memory components required to finish PC builds. Management expects this issue to be largely resolved over the next few months. Given current memory industry turbulence exacerbated by the pandemic, investors should be aware of the risks of investing in memory technology, where volatile pricing can drive big stock swings. Additional risks include lower than expected sales of computers and consumer electronic products, faster than expected capacity expansion in the memory industry, and less than anticipated cost cuts. No regular supply of innovative products. Over the years the company has developed numerous products, but those are often response to the development by other players. Intense competition in the industry. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.